Hi everyone, this is Prashad Parthiban. Today I am going to talk about captive insurance. This type of insurance is totally different from traditional insurance process because in traditional insurance, if a company needs insurance coverage, they go to standard insurance companies and they pay premium, and as a result of that they get insurance policy coverages from the standard insurance companies. Whereas in captive insurance, if say you have a big company, right? Yeah, maybe a big amusement park or a big retail company that is paying premium more than 500k, like maybe 800k, 900k per year, and maybe in the last 3-4 years they have been paying more than 1 million in premium, whereas their losses are very minimal compared to what they pay in premium. Their losses are very minimal. As a result, they are paying more than what they're getting, right? So in that scenarios, they can form something like captive insurance company. So the way it works is they will have captive managers who will kind of do some kind of feasibility study to understand if it makes sense to form a separate insurance company that will provide coverage only for that particular customer, right? For example, if you take a big amusement park, they can set a separate insurance company on their name, and that particular insurance company will only serve that amusement park, right? Like typical policy issuance, claims process, everything will be the same, just that that particular captive insurance company will serve that particular customer. Now, most of you will have a basic question, right? What is the benefit? In case of standard insurance companies, once you pay the premium, even though you are recouping that in terms of claim or anything else, the premium is premium, it's not going to be refunded to you, right? Whereas in case of captive insurance, say you have a very good risk management strategy and you are very confident that you are not going to have major losses. Whatever the premium that you are putting there, if you are not going to use it in claims, then those are going to be a profit to you, right? At the end of the day, it's your company. You have formed this entity for this insurance company. So if you are not going to have major claims, that extra money that is sitting in that insurance company's bucket is going to be underwriting profit for yourself as a company. That is the reason why big companies which has been paying like 800k, 900k per year on premiums, they try to do some kind of feasibility study to understand if they can form a captive insurance. Now that we have seen what is captive insurance, why we need it, there are different types of captive insurance, right? Like as similar to traditional insurance, here also we have different types. The first type is pure captive, which is nothing but single parent captive. Say a big retail company like Walmart or Target, if they wanted to form an insurance company, they can form the insurance company, and that insurance company will serve only that entity, like either Walmart or Target, right? So that's the reason why they call it as pure or single captive. So the benefit here is, if that company doesn't have any big losses, the underwriting profit can be used solely by the pure captive insurance companies. The second type is group or administrative captive. Here maybe 5 to 6 organizations can come together, and then because of their similar nature in business, maybe a pizza shop, 10 pizza shops can come together and they can form a group captive, and as a result, if there is any losses to one of the 10 pizza shops, we can pay the claim out of that group captive. The benefit here is, because of the fact all 10 are having the similar operations, there could be a very good understanding about their loss nature, and also if there are any underwriting profit, it can be shared among the 10 pizza shops, right? The concept here is, here it is single captive, whereas here it is multiple companies coming together which have similar kind of operations and forming a group captive. Third one is sponsored captive. Again, assume that a big amusement park has their own captive insurance company, right? Now there is a small shop, tire shop, which cannot have huge capital. So what they can do is they can rent some portion of that big captive insurance. In that case, as I told you, if a big amusement park have some insurance coverage for themselves, the small companies can go and rent some portion of their coverages to them. As a result, they will pay some premium. So that is what is called as sponsored captive, where they don't own it, but they rent it for a temporary period of time to avail that captive insurance options. In short, as I told you, captive insurance is a very attractive one. If you have a big company and if you are paying many amount in premium, right? On top of all those things, right, there are some benefits too. One, using the reinsurance options. As a captive insurance companies, you can always go to reinsurance companies and reinsure some of your losses. As a result, if there is any catastrophic loss like wind or flood, you are not going to be at major loss, right? Second thing is tax benefit. Sometimes what happens is, because of the fact you have your underwriting profits, you can have some tax deferment there. Plus the premiums also can be used as or shown as business expense, so you don't need to pay some kind of tax. So there are a lot of benefits, but again, as I told you, you have to do a thorough feasibility analysis on this, because insurance company by itself is going to be an entity. It's going to have some extra admin charges. Maybe you have to file your company as an entity and work with your regulatory bodies. So you have to do a thorough feasibility analysis. But if you think, if you have a company which is big enough and your risk management strategies are very good enough, it is always a good try about captive insurance. Once again, thank you so much for your support. Have a great day. Bye bye.